Hey everyone, Paul Clark here, and I'm actually on vacation in California. I live in Michigan, and I've been thinking about wanting to create a YouTube channel related to stocks for a while now. And I feel like I was starting to get some good ideas. I put up a couple videos at this point, and I didn't want to let myself get derailed because I'm actually going to be in California for 20 days. So I said, you know what, I need to actually film these. Even when I'm on vacation or even when I'm out of the state, I need to get in the good habit of being able to create content. So that's what I'm doing, so I don't have kind of the normal access that I usually would. But with that in mind, I want to, in this video, talk about Apple stock. Now, there's been a lot of news going on with Apple, a lot of interesting things happening, so I wanted to cover it, talk about some of the short-term moves and what that could potentially mean for the long-run investor. So first of all, Apple just went through a stock split. So they went, for a 4-to-1 split. What that did is it decreased the share price, and there was a lot of frenzy around that because before the split, Apple was trading at about $500 a share, and then post-split, it's going to be looking at trading at $100 and change, essentially. And what that was going to do, or the theory behind it, was that that's going to make it more accessible for more investors to be able to purchase at a lower share price. Now, again, that's the speculation, and I think that rationality used to make a lot more sense, but I think in today's world of fractional share purchases, that's not quite as relevant as what it used to be. So with a lot of platforms, including Robinhood and Schwab, you're at Infidelity, you're able to actually buy fractional shares or slices of the stock. So even if you were actually wanting to buy into Apple at $500 and you didn't have the $500, all you had was $100 or $10 or whatever you had, you would actually still be able to purchase that. So again, I don't think that was quite as relevant, but regardless, that still actually led to the share price being bid up in a frenzy of speculation of investors and traders wanting to profit from that potential spike. And then what happened is that after the actual split took place on Monday, the stock since Tuesday is actually down nearly 11%. And after becoming the first U.S. company to be worth over $2 trillion, which is 2,000 billion dollars. And I don't really know if there's an easier way to just really express the magnitude of what 2 trillion is. It's huge. It's the largest company in the United States, publicly traded. But yeah, it's just, that's huge. But with the pullback, they actually did fall back below that $2 trillion mark. Now, that being said, the Wall Street Journal put out a pretty interesting article taking a look at all the companies since the 1930s that have actually been the highest valued companies, and what their fate ended up being, how long they actually were king of the hill, and things of that nature. And what's interesting is that AT&T was really the only company that had a multi-decade run at being number one, or being the most expensive or highly valued stock on the stock market. But when you look at some of the other stocks, you look at GE, or let's see here. When you look at GM, they had a good run in the 50s as far as being one of the most valued companies. When you look at IBM, they did really well in the 70s and 80s. You had GE taking over in the 1990s and early 2000s as one of the most highly valued companies. And now most recently Apple has really kind of taken that over. But again, one of the key things there is that a lot of these companies that were highly valued, again, we go back to thinking about AT&T, where they were once on top and now they're no longer in the top 100. GM used to be the most valued company. They're not even in the top 1,000 in terms of valuation. And then just kind of continues to go on down the list, where even GE, of course, is now out of the top 100. So all of that is to say that when you're actually at the top, it's certainly not easy to achieve, first of all, but it's not easy to stay there. So, and right now with Apple being valued at $2 trillion, or approximately $2 trillion, it's kind of baked into that they actually are going to be incredibly successful for the next several decades. And like I said, just based on that survey of companies that have been on top, the odds are basically stacked against them. And, I can even tell you that, I'm a member of a couple different Facebook groups related to the stock market and trading and investing. And, Apple and Tesla have really been dominating the discussions. And a lot of people have just really been thinking that it's, a foolproof approach to just, keep piling money into Apple, piling money into Tesla, and that's just going to keep going higher and higher and higher. And, and what's really unfortunate with the correction that's taking place, or had taken place over this previous week, and I'm filming this on 9/5, when you're on vacation, you got to check the date. So that being said, there was just all this talk about wanting to just pile into them, just really, for no other reason, not saying, hey, I'm piling into this because of, this innovation or because of these fundamentals, but all of just hoping, hey, I'm hoping to buy to this price to have it keep going higher and higher and higher. And I feel like when you just get a lot of people just focused on that and thinking that it's inevitable, that it's just going to keep surging higher, and they're just, there's a speculative frenzy that you're kind of seeing, that's always kind of a bit of a, a reason for caution in those types of situations. And the other interesting thing is when you actually do look at Apple from a fundamental perspective, you start to think about the actual products they make. So even the iPhone market. So certainly smartphones overall is a growing market, but the market share of the iPhone has been steadily declining over the past 8 years. And even on a forecasted basis, they currently have about a 14.6% share of the smartphone market, and that's projected to drop down to 13.6% by 2024. So again, that continues to shrink, and really Apple is kind of at a point where, certainly with right now, their price to earnings ratio is about 37, which means that the company is, if you take it what they're earning in a year, projected to earn for 2020, the company is worth 37 times more than their projected 2020 earnings. And, when you look at that number, that's a really aggressive number. That's a number that would really be applied to a growth stock. And again, when you're at 2 trillion, it's actually really hard to double when you're that big already. You think about, if you're already like a really, if you're into weightlifting and you've already got really big muscles, yes, that can be great, but it's really hard to go from like, a 20-inch bicep to a 40-inch bicep. In fact, it's almost impossible, right? But maybe if you have a 10-inch bicep, maybe you can go to that 15 or that 20 pretty easy, right? So I feel like when you're relatively small, you have a larger runway for growth, but you certainly don't have as easy of a path when you're worth 2 trillion. And again, that's really key because the way they're valued says that they need to have that growth to keep up with their valuation. So right now, if they were worth $2 trillion and their price to earnings multiple was something closer to 15, right? Then all of a sudden you could say, okay, like that makes more sense relative to what they're earning. You kind of couple that with a solid and increasing dividend, you all of a sudden can have a little less, reason for pessimism about that type of situation, but that's not the way it currently is. Another risk here is that if the recession either lasts longer or if there's a double dip with the recession, that's going to cause an operational issue with their stores. Any of those things could be a risk. But you also think about Apple, their products are a premium product, and there are other lower cost options out there where if the recession lasts longer, people dealing with unemployment, that might push them into getting some cheaper devices. It might also push them into saying that they can delay the purchase of their Apple products if they actually are loyal to that brand. So they might be waiting longer because of the recession and things of that nature. So something to keep in mind as well. And again, so we talk about the price to earnings for Apple being at 37. That really implies that they, have, really high growth forecasted or required really to support this valuation. And again, there's no guarantee that that's coming. And finally, since 2017, keep this in mind, Apple, if you look at it on a post-split adjustment, they still, from their valuation, they've more than doubled what Apple is worth. But in that same time period, their sales and their profits have actually increased by less than 15%. So again, when you look at the share price, it's increased by more than 100%, but their profits and their sales have actually increased by under 15%. Now again, 15% increase in profit and sales since 2017, though that's a good number, but again, you have to keep that in mind relative to the actual valuation, right? So if you were seeing sales and profits increase by 15% and the stock was up 5%, certainly the conversation becomes shifted, and you can say, hey, maybe the valuation hasn't really kept up with that growth, and that could represent a good opportunity, right? But that's not really what's happening here. So I think when we think about, the recessionary pressures that are going to be with this company, with Apple, I think in the short term that there's certainly going to be some challenges. So certainly if you're going to be investing and you actually do believe in this company long term, I think it's a good time to understand if you actually have the stomach to be able to handle fairly significant losses. Like, let's say if the stock does go down by another 20%, not saying certainly that it will, I'm saying that I think it's something that you should be prepared for, something that could be happening, because one of the worst things you can do as an investor, if you believe in something long term, is to buy it, watch it decline by a fairly significant amount, then sell and then watch it recover. So again, really make sure that if you're going to get into this, that you understand that that is a risk, and understand if you either have the capital to add to your positions as it goes down, you have the fortitude to hold, just certainly something to be aware of. And again, on a long-term basis, just be aware that whenever there's been a company that has been the most expensive company on the stock market, it's not something that's been able to hold its position, forever, right? So when is that going to be for Apple? We don't know, of course, but there certainly will be a day, if it's going to be 20 years from now or 40 years from now, where Apple will no longer be the most expensive stock on the stock exchange. And again, how far will it fall? We'll have to find out. But again, I think putting that in perspective about the other companies we talked about, I think will help out a lot with that. So whatever your direction is or your thesis is with Apple, I wish you all the best, and appreciate watching this video. Any questions, comments, go ahead and let me know, and see you next video.